a special programming Central Bank Monetary Policy Committee meeting. Decisions expected from the Central Bank Governor within the next few minutes. We welcome our viewers here in Nigeria and around the world. Our panel is here to take a look at what's the look back into the last MPC, what are the background to the current meeting 25th and 26th of March. Johnson Chukwu, the CEO at Carrier Asset Management, Ayode Jiebo, also a CEO at Afrinvest Securities, and of course, Biteo Duneye, who is the Chief Executive and Managing Director at Eagle Global Markets. Gentlemen, thank you very much. Very interesting conversation we've had so far, but while we wait for the communique from the Central Bank Governor, you never can tell. There could be a surprise. I always try to hold that view on this side of the table at all times. You never can tell. But when we look, let's look at the global space. We're talking about Brexit. We're talking about the yield curve in the U.S. environment, with the U.S. Fed now signaling there'll be no rate movement in 2019. The Eurozone economy is also kind of flirting with recession already. All of that is coming as some strong headwinds now that most likely will be part of the concentrations today for this meeting. Peter, let's start this round from you. The global headwinds, how do you think this will impact us locally moving forward? We're looking at whatever decisions are taken today, we need to deal with the 2019, we need to deal with 2020, at least in the short term.
Well, looking at the global economy today, arguably I've not seen it any more uncertain in the last 4 years than it has been today. We have major issues in Europe. The economies of Germany and France look like they could possibly be going into a recession. We had the Federal Reserve increase interest rates last year quite a bit, only to find out now that there's a possibility that they might be cutting back down to zero. As you mentioned, a couple of days ago, we saw an inverted yield curve, which caused a lot of panic, or we saw a general sell-off in a number of the global markets. We've got Brexit also causing some sort of contagion with Europe. We've got issues between the two biggest economies, Russia, China and America, not agreeing on several trade policies. How does that affect the prices of commodities? We've not seen the demand for commodities be that as much as it was before. Now, we are an oil-driven economy. Yes, oil has gone at $60, but the global uncertainty could cause us to dip in oil. So I wouldn't say it's scary. We just have to really take very good care of our own ship, because globally, it looks as if everybody seems to be having some sort of problem or another. So the most important thing for us, I mean, we would protect against whatever issues come as a, if interest rates were to fall, that would be good for us. If we could, if at least the oil price should stabilize, that would be good for us. But importantly, we also have to come up with our internal policies that puts us in a position to take advantage of whatever comes up. Exactly.
Ayodeji, do you think we have what it takes? Do you think we have the life jacket within the current monetary policy situation or environment at home to deal with if, for any instance, things change and there's a massive outflow from our market beyond what we've seen so far, not just on equities, but also on fixed income?
Yeah, I don't think Nigeria would benefit significantly from the accommodative policies that have been seen by developed markets or developed economics. Now, the most other emerging markets or sub-Saharan Africa, the nations may benefit more because they perceive in terms of the risk environment. Yeah, beyond the fixed income, which we know, or money market, which is short term, and due to the stability that with the I&E window has provided in terms of liquidity, and also the features that for most of the foreign investors, they are also able to hedge. Beyond that, to get foreign direct investment, we need to do a lot of things in terms of our policies. We need to look at in terms of our private sector driven policies, PPP arrangements. We need to review those policies such that in terms of financing infrastructure, you can see a lot of partnership within that space, because we've not seen any case study, any study of any PPP that has really worked in Nigeria. It should also be a concern. That's why are people not going that route. So in terms of benefiting from the newly accommodative policy that we've seen across the US, the Eurozone. I feel that Nigeria is not well positioned, rather than beyond the hot money that we may continue to see.
Johnson, we need to mobilize domestic capital, and we need savings. 14% headline interest rate. I'm not sure leaves little for the piggy bank outside consumption.
Well, the challenge we actually have in terms of mobilizing savings, local savings, is because if you look at the income distribution in the country, you realize that a reasonable percentage of the Nigerian population is actually living below poverty level. But beyond that, you also have to contend with the issue of cost of living, the increase in the cost of living over the past 4 years. We've seen a consistent increase in the cost of living, which has eroded the disposable income of consumers and left them with minimal discretionary income. So because what you save is actually discretionary income. For you to...
Johnson Choko, we need to hold our discussions here in the studios. The Central Bank Governor, Godwin Emefiele, is live and ready now, reading his communique. Let's take a listen, everyone.
Of development in the global and domestic economic environments in the first quarter of 2019. 11 members of the committee were present. The global economic developments. The committee noted with concern the weakening performance of global output growth at the end of 2018 and observed that developments in the first quarter of 2019 were characterized by legacy headwinds from the second half of 2018. These include the continued trade war between the United States and China, policy uncertainty amongst the advanced economy, central banks' persisting uncertainties surrounding Brexit negotiations, vulnerabilities in major financial markets, and rising public debt in some emerging markets and developing economies. Consequently, global output growth for 2019 was downgraded by the International Monetary Fund, IMF, from 3.7% to 3.5%. Price developments across advanced economies continue to moderate in the review period alongside signals of weakening output growth. In the light of this development, the US Fed, the Bank of England, and the European Central Bank retreated from their earlier stance of monetary policy normalization in favor of a monetary policy accommodation. This led to volatilities in the financial markets of the advanced economies as the balancing of portfolios moved capital from the equities to the bond markets. The MPC noted the moderate appreciation of the US dollar against currencies of most advanced and emerging market economies. It further noted the trend of declining long-term yields in the United States and the likelihood that capital flows may be redirected to emerging market and developing economies in the medium term. Domestic output developments. Output data from the National Bureau of Statistics, NBS, indicate that real gross domestic product, GDP, grew by 2.38% during the fourth quarter of 2018, from 1.81% and 2.11% in the previous quarter and corresponding period of 2017. The major impetus for growth came from the non-oil sector, which grew by 2.7% during the fourth quarter of 2018, while the oil sector contracted by 1.62%. Committee welcomed the continued positive sentiments in the manufacturing and non-manufacturing purchasing managers indices, PMI, for the 24th and the 23rd consecutive months in March 2019. The manufacturing PMI rose by 57.4 index points compared to 57.1 in the previous month. Similarly, the non-manufacturing PMI increased by 58.5 index points compared to 58.4 in February 2019. The increase in both measures of PMI were driven by increases in production, employment, raw material inventories, and new orders. This improved outlook was attributable to the continued stability in the foreign exchange market, various interventions by the bank, in the real sector, and the effective implementation of the Economic Recovery and Growth Plan by the federal government. Furthermore, on the current measure of national output, the MPC noted the need to rebase the GDP, an exercise which was last carried out in 2010. Developments in the money and prices. The committee noted that broad money supply contracted by 1.98% in February 2019, below its level at December 2018. Net foreign assets contracted by 7.47% in February 2019, relative to its level at the end of December 2018. In contrast, M3 grew by 4.31% in February 2019, compared with its level at the end of December 2018. Net domestic credit also grew by 10.68% in February 2019, and the growth in NDC was accounted for by the increase in the credit to the government, which grew by 17.2% in February 2019 over its level as at December 2018. Credit to the private sector also rose by 6.41%, compared with its growth benchmark of 9.41%. Given the positive trajectory, the committee urged the management of the bank to sustain the various initiatives of the bank, particularly the partnership with the Bankers Committee and the Nigerian Incentive-Based Risk-Sharing System for Agricultural Lending, NIRSAL, aimed at establishing a national microfinance bank to cater for the micro, small, and medium enterprises, as well as the small and medium enterprise sectors of the Nigerian economy. The committee noted the continued moderation in inflation, as headline inflation year-on-year declined further to 11.31% in February 2019 from 11.37% and 11.44% in January 2018 and December 2018 respectively. The decrease in the headline inflation was driven mainly by food inflation, which declined to 13.47% in February 2019 from 13.51% in January 2019, while core inflation declined marginally to 9.38% from 9.91% in the previous month. On a month-on-month basis, headline food and core inflation declined by 0.1 and 0.01 and 0.15 percentage points to 0.73, 0.82, and 0.65% in February 2019, respectively, from 0.74, 0.83, and 0.81% in January 2019. The committee noted the upside risks to inflation to increase, high cost of energy, infrastructure constraints, insecurity in some parts of the country, and anticipated increase in liquidity from the late implementation of the 2018 budget, and noted that most of these factors were outside the ambit of monetary policy. The MPC therefore urged the federal government to sustain its current efforts in stimulating output growth by executing the policies approved by the Economic Recovery and Growth Plan. The net liquidity position reflected the impact of open market operation auctions, foreign exchange interventions, statutory allocations to states and local governments, and maturing CBN bills. Consequently, average interbank core rate increased to 16.45% in February 2019 from 15.0% in January 2019. The open buyback OBB rate, however, declined marginally to 18.79% in February 2019 from 19.71% in January 2019. On March 22nd and the 8th, 2019, the OBB and interbank core rate, however, closed at 14.39 and 8.0% respectively within the monetary policy rate corridor. The committee noted that in spite of the recent upsurge in capital inflows into the economy, the oil share index and market capitalization continue to decline, reflecting global sentiments in portfolio rebalancing from the equities to the fixed income securities. These reflected generally perceived risks at the long term end of the yield curve. The committee noted with satisfaction the continued stability in the foreign exchange market at the investors and exporters window of the market, and in particular, it also observed the moderate improvement in oil prices and stable accretion to external reserves, which stood at 44.23 billion as at March 21, a 6.8% increase from 42.35 billion at the end of February 2019, and 6.38% growth at the end of January. The overall outlook and risks. The medium-term outlook for the global economy continues to be uncertain, with indications of increasing macroeconomic vulnerabilities and downward revision of the forecast for global output growth. On the domestic economy, available data on key macroeconomic indicators for output growth during the first quarter of 2019 and forecasts for the rest of the year suggest continued positive outcomes. Based on recent projections, the economy is expected to grow by 2%, that's the IMF, 2.2% by the World Bank, and 2.74% here at the CBN. The projection is hinged on the enhanced flow of credit to the real sector, sustenance of a stable exchange rate regime, moderating of inflation rate, the CBN special interventions in growth-enhancing sectors, especially agriculture and non-agricultural SMEs, improved growth in the non-oil sector, and the effective implementation of the ERGP by the federal government, among others. Committee expressed optimism that the establishment of the NIRSAL, National Microfinance Bank, and the enactment of the Secured Transactions in Movable Assets Act of 2017 will stimulate lending to small and medium enterprises. Staff forecasts indicate that inflation will commence a marginal upward trend from March 2019 through May 2019, when prices are expected to begin trending downwards. The committee acknowledged the headwinds to these forecasts to include low credit to the private sector, increasing external debt burden, volatility in the financial markets, fluctuating oil price, threats to capital inflows, and decline in external reserves, which could exert pressure on Naira exchange rate in the medium term. The committee's consideration. Committee observed the tepid output growth in 2018, but noted with satisfaction that it strengthened in the last quarter of 2018, as well as positive forecasts for 2019. It further noted with great satisfaction the continuing moderation in all measures of inflation, sustained stability in the exchange rate, and the robust level of external reserves. It commended the recent upsurge in capital inflows into the economy, noting this to be a demonstration of sustained confidence by foreign investor community in the Nigerian economy. The committee was, however, not unmindful of developments in the global economy, noting the recent slowdown in growth in some advanced economies and the dovish stance of some major central banks as an early warning signal of broader macroeconomic vulnerabilities. It therefore underscored the need to monitor the trend of capital flows and the continued downturn in the equities market, noting that the recent surge in portfolio inflows were concentrated in the money markets. The committee noted the relative volatility in oil prices and its impact on accretion to reserves, which could easily undermine the stability observed in the foreign exchange market. It, however, noted that current developments in the oil futures market indicate that oil prices will remain considerably above the federal government's 2019 budget benchmarks. The committee therefore urged the federal government to strengthen the current revenue mobilization efforts, as well as explore additional sources of revenue in order to improve fiscal buffers. It further urged the federal government to sustain its implementation of the ERGP while ensuring that growth is all-inclusive. It reiterated the need to concentrate efforts on addressing the problem of power infrastructure as well as support domestic manufacturing. The committee also called on all relevant institutions to address the menace of smuggling and dumping of goods into Nigeria and encourage the management of the bank to continue to explore available scenarios to deal with the activities of economic and policy saboteurs, including those involved in dumping and smuggling, in a bid to accelerate domestic production of goods in Nigeria. The MPC noted the positive moderate outlook for growth and the risk in the horizon. The committee also noted that, having achieved a relatively stable exchange rate with price stability, it is imperative that the monetary policy should explore the next steps necessary for enhancing growth, reducing unemployment, and diversifying the base of the Nigerian economy. It further observed that per capita income growth is very negligible, while aggregate demand remains weak. Aggregate output also remains below the potential output level, implying sufficient headroom for non-inflationary growth. The new direction has therefore become imperative against the backdrop of the aftermath of the general national elections and strong inflow of foreign direct and portfolio investments into the Nigerian economy. The committee urged for the speedy passage of the other aspects of the petroleum industry bill to fast-track the development of the value chain in the sector and create employment. It also welcomes the passage of the National Minimum Wage Bill by the National Assembly and called for its speedy implementation in order to boost domestic aggregate demand. The committee also observed that the performance of the monetary aggregates were below their benchmarks, indicating headroom for monetary growth. The MPC also noted the encumbrances and constraints imposed on fiscal policy and the associated vulnerabilities, as it has consistently failed to mobilize sufficient revenues to support development as enunciated in the Economic Recovery and Growth Plan, leaving room for continued debt servicing not previously envisaged. Against this backdrop, it is imperative for monetary policy to provide the much-needed leverage to support output growth and employment generation in the country. On a more cautious note, the committee expressed concern and sympathizes with the fiscal authorities over the growing fiscal deficit, external debt and debt services, as well as the need to closely monitor the public pronouncement process in order to improve efficiency in public resource management. On financial system stability, the MPC noted the improvements in key financial soundness indicators and commended the federal government for the settlement of debt owed to oil marketers, which has considerably helped in reducing the non-performing loans portfolio in the banking industry. The committee therefore urged the government to expedite action in addressing all outstanding contractor-related areas so as to improve the MPR position and stabilize the banking system. In addition, the MPC reiterated the bank's commitment to improve credit delivery, especially to small and medium-scale enterprises, while acknowledging efforts by the Central Bank of Nigeria in coordinating the de-risking of lending to the private sector through collaboration between the Bankers Committee and the NIRSAL. In its consideration of the best monetary policy option, the committee noted the need for all agencies of government to work hard, not only in consolidating the growth so far achieved, but also in ensuring that appropriate policies are put in place and implemented to create jobs on a mass scale, as well as diversify the economy in the proper direction. In doing this, the policy options facing the MPC at this meeting is a decision between retention of the current stance of monetary policy or a slight loosening at the policy rate, backed by the substantial stability of the major macroeconomic indicators. The committee felt that given the relative stability in the key macroeconomic variables, there is a need to signal a new direction, and in which case we're talking about being pro-growth. In its argument, the committee was convinced that doing this would further uphold the bank's commitment to promoting strong growth by way of encouraging credit flow to the productive sectors of the economy. The MPC also felt that signaling through loosening by a marginal rate would serve to manage the sentiments in the capital flow markets owing to the wider spread in yields in the emerging market and developing economies relative to the advanced economies. Moreover, the real interest rates would still remain positive. Committee's decision. In the light of the above, the MPC decided by a vote of 6 out of 11 members to reduce the monetary policy rate by 50 basis points, that is 0.5%. 2 members voted to reduce the monetary policy rate by 0.25%, 25 basis points, while 1 member voted to reduce it by 100 basis points, which is 1%. 2 members, however, voted to hold MPR at its current level. 10 members voted to hold all other parameters constant, while a member voted to reduce the cash reserve ratio by 100 basis points from 22.5 to 21.5. In summary, the MPC voted to 1. Adjust the MPR by 50 basis points from 14 to 13.5%. 2. Retain the asymmetric corridor of plus 200 and minus 500 basis points around the MPR. 3. Retain the CRR at 22.5%. And 4. Retain the liquidity ratio at 30%. I thank you all for listening.
Thank you, Governor. Distinguished ladies and gentlemen, we have listened to communique number 123 of the Monetary Policy Committee of the Central Bank of Nigeria. This is the time for questions and answers. And as usual, we have to strictly abide by the House rules that extraneous issues should not be brought to this discussion. And so, we would want those who have questions or clarifications to seek to come over here, tell us your name, and please, 1 question. Nancy, I can see you walking towards you. Chief Mrs. Nancy Naji.
Thank you, sir. Good afternoon, Governor. I don't know what to say. Is it a surprise by MPC to reduce the rate to 13.5%? I'll start my question by asking, this recent reduction now, is there a relationship because you are pushing towards MSMEs? So is there a relationship between funding of SMEs and the loosening stance of the MPC? Number 2, during your speech, you made mention that Naira may just be under pressure in the medium term. I want to understand that. I was reading something last week in one of the dailies online, and it did say that the Naira is being forecast to be like 400, 500 Naira later this year. So I really want to know, have an explanation for that. This global financial crisis that a lot of people are touting that may just be on before the end of the year, do you think that Nigeria is adequately prepared to face another financial crisis with an FX reserves of $44 billion? I'm actually worried about that. Thank you, sir.
Thank you. We had to waive the restriction because Nancy is a chief Mrs. Udo.
Hey, Governor, I don't know whether this one is a parting gift. The question I want to ask is, you said that the projection of the CBN, you said that last week, but what you are saying now is different, that the economy is going to grow by 2.7%. What gives you this confidence, sir?
Thank you.
Good afternoon, Governor. My name is Biodun Dare from Radio Nigeria. I would like to find out what you foresee this marginal reduction in the MPR would achieve. And also, you announced about 2 MPCs ago introduction of differentiated CRR. How much impact has that had so far?
Thank you. I think that's all. Okay. Sir Chief Matthias Okwe. One question.
Yeah, only one question. Thank you, Mr. Governor. You have done it again. You did it in 2016. I remember we were in the U.S. when something like this cropped up, just like what happened in Lagos. And the next MPC, you dropped the bond share. So you have done it again. Everybody was concluded that you are going to continue with the tightening, but you have done it again. But the question is, we have seen this over the years. It begins to sound like a ritual that even when you lose, the banks do not really affect this thing. What are you doing this time around to make sure that the reduction also affects the market? Thank you, sir.
Hi, good afternoon. Shala Piran of Bloomberg News. So is this the beginning of the MPC's rate cutting cycle? Is this the beginning of the MPC's rate cutting cycle?
Rate cutting cycle.
Okay. Whether it is the beginning of MPC's rate cutting cycle. Okay. That should be the last.
Yeah, what question? Good afternoon, Governor Oyewa Chukwu from Business Day here. Just wanted to find out really, last month, Indian oil company announced, which is, by the way, the biggest buyer of our oil, announced the deal with the U.S. As a policymaker, I wanted to find out whether there's any implication for this, for the economy, and whether there are concerns and possibly, talks at your level around this at the moment. Thank you.
Okay, so those are the questions. It's now time for the governor to respond to them, as usual. Governor, sir.
Well, thank you very much. Nancy asked if there is a relationship between funding the SMEs or maybe reducing rates and the loosening stance that we signaled today. I would say to a reasonable extent, yes, there is a relationship between lending to the SMEs, not just SMEs, to the agriculture and manufacturing sectors or the real sectors of the economy, and our decision today. The reason being that if you consider the fact that, for instance, January 2017, inflation had attained a level of 8.72%. By October 2017, as a result of the pressure in the global market, reserves had dropped to about 23 billion. By that same month, even what was being accreted into central bank had dropped to even about just $500 million from as high as about over 3 billion in sometime in August 2013, 2014. If you also recall that sometime February 2017, exchange rate as a result of the pressures had accelerated to as high as 525. But that if you compare those numbers with where we are today, inflation at 11.3%, reserves at actually close to 45, and we feel this trend will continue. Exchange rate converging in all the markets at around between 358 to 360. GDP effectively, I would say, being in positive trajectory consistently for almost about 5 to 6 quarters, then you would agree with me that there has been a relative stability, and we have proved that there is a sustainability in the level of stability in the macroeconomic indices in Nigeria.